Hello, welcome back to this week's market update. Today is Monday morning, July 29th, 2024. We had a very full week last week, so we will jump right into this week's market update. Last week was marked by significant economic data releases, including PCE inflation, personal income spending and savings figures, as well as a preliminary GDP report for the second quarter of 2024. As of close on Friday, July 26th, the Dow Jones Industrial Average was up 0.75% on the week, followed by the Barclays Aggregate Bond Index, which was up about 0.28% on the week. And then on the other hand, we had the Nasdaq and S&P 500 down on a sell-off of large cap technology names. The S&P 500 was down 0.83% on the week, and the Nasdaq Composite down 2.08% on the week. Heading right into this week's economic data, we got the June PCE inflation report last week. PCE inflation came in at 2.5% from a year ago as expected, and then the core number, which excludes food and energy, that was up 2.6% from a year ago. So definitely getting closer to the range that the Federal Reserve is hoping for in order for them to start cutting rates. And then on a monthly basis, PCE was up just 1.1% in the month, and core PCE was up 0.2% in the month. So continuing this trend of disinflation, that is the rate of inflation slowing. We're not seeing deflation yet. I don't expect that we will, but the fact that we are getting closer to the Fed's 2% target in their preferred metric, which is this PCE here, that is a great sign, and the market is definitely taking notice of that. Also, with the PCE report, we get some great data on personal income, spending, and saving habits in the same month. Here you can see for the month of June, disposable personal income, which is just income less taxes, that rose 0.2%, so a fairly moderate increase there. But personal outlays, which is essentially personal spending, that rose 0.3%. So when the growth of your spending is higher than the growth of your income, that ultimately leads savings to drop lower, and that's what we saw the personal savings rate drop off to 3.4% in the month of June. So overall, these figures suggest a stable and still growing US economy, although just at a lower pace. So that aligns with the Fed's aim of achieving a soft landing. We'll continue to watch the data and see how it comes, but for now, it looks like we are getting softer economic data, but not so soft that we should be concerned about a recession. Last week, the advanced estimate of second quarter real GDP growth surpassed expectations, indicating that the US economy grew 2.8% from a year ago in the second quarter. The increase in real GDP primarily reflected rises in consumer spending, private inventory investment, and non-residential fixed investment. Then on the other hand, imports, which are a subtraction in the GDP calculation, they increased, so that reduced the GDP report slightly. But overall, this is a fair quarter of economic growth. It is better than expected. However, it does remain below longer term growth averages for the US economy. So it does indicate that we are in a little bit of a softer period, again, coinciding with the soft landing that the Fed is hoping for, but still growing at a fair pace that we are not nearing a recession. Overall, I would say this is a positive GDP report, just given that we were better than expected, and also the fact that we are still growing close to 3%, even when adjusted for inflation. So a little bit below the longer term norms, but overall fairly positive. Shifting gears to some more residential real estate data, June existing home sales data was released last week, showing a total of 3.89 million homes sold in the month. This represents a 5.4% drop in volume from May, as well as a 5.4% drop in volume from June of 2023. Despite the slowdown in sales volume, the median sales price of an existing home reached an all-time high of $426,900, which was up 4.1% from a year ago. This price also signifies the 12th consecutive month of year-over-year price gains. So over the last year, the median sales price of an existing home sold has not decreased whatsoever, not even in 1 month. Very interesting there. And then finally, the inventory of existing homes rose to 4.1 months there, up from 3.1 months in June of 2023. So inventory is starting to sit on the market longer as the impact of interest rates, higher interest rates, keeps people where they are and prevents the existing home sales market from moving as fast as it would, like it did before the Fed began hiking interest rates. So overall, here you can see that sales prices of existing homes continue to rise, but volumes are dropping off, and that's mainly due to higher interest rates. Along those same lines, new home sales data came in for the month of June as well, showing 617,000 new homes sold in the month of June, which was the lowest monthly volume in 7 months and a 7.4% drop in volume from the same period last year. On the other hand, the median sales price of a new home was up 2.5% from May to 417,300, although this was actually flat compared to June of 2023. So the new home market is continuing to slow down, probably even slower than the existing home sales market, as higher interest rates impact volumes from moving and keep consumers where they are in their current home, as opposed to financing a new home at a higher price, at a higher interest rate, and a higher monthly payment. So, again, really interesting trends here. You can see new residential sales. They skyrocketed in 2020, 2021, and ever since then, we've been on the decline. So, really important stuff just to see how consumers are reacting to higher interest rates. Last but not least, we had a few updates to our recession indicators board. You can see here the Philly Fed Manufacturing Business Outlook Survey that actually recently turned bullish in the month of July. And previously, it was neutral, so that was a good sign there. And then the second one was the Chicago Fed's National Activity Index that turned neutral from being previously bullish before. So overall, you can see that our indicators continue to look pretty mixed. You can see we have 4 bullish indicators, 3 bearish, and 1 neutral. So overall, again, still pretty mixed. We're not sure if we are in store for a continued slowdown or maybe a reversal into more of an expansion. Really just depends on the upcoming quarters of economic data. So overall, continues to look mixed. Really could go either way into an expansion or a contraction or just a slowdown in general. But we will continue to keep an eye on these indicators and watch markets closely. Thank you so much for tuning into this week's market update, and we look forward to providing another update for you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.